In a significant move towards economic integration and cooperation, Nigeria has entered into a tax treaty with ECOWAS countries, Economic Community of West African States. This treaty aims to eliminate double taxation on income, capital, and inheritance, fostering a more conducive environment for cross-border trade and investment within the region. In this video, we will delve into the details of the treaty, explore its implications through real-world case studies, and consider the underlying principles of international taxation. So stick around till the end. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of taxmobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Definition, purpose, and objectives of a tax treaty. So what is a tax treaty? A tax treaty, also known as a double taxation agreement, is a bilateral agreement between two or more countries to avoid or mitigate the effects of double taxation. This means it outlines the tax obligations of individuals and businesses that earn income in one country while residing in another, ensuring they don't get taxed twice. Purpose. The primary purpose of a tax treaty is to facilitate international trade and investment by reducing the tax burden on individuals and businesses operating across borders. By ensuring that income is not taxed twice, tax treaties promote economic cooperation and prevent tax evasion. This creates a more favorable environment for cross-border activities and helps maintain fair taxation practices. To truly grasp their significance, let's look at the objective of the treaty. Elimination of double taxation. The treaty aims to ensure that earned income is only taxed once, either in the country where it is earned, source country, or where you live, residence country. Tax certainty and stability. Clear and consistent tax guidelines are crucial for planning and investment. The treaty aims to provide these guidelines, thereby reducing the risk of disputes and creating a stable tax environment where businesses and individuals know exactly what to expect regarding tax obligations. Promotion of cross-border trade and investment. By lowering tax barriers, the treaty would make it more appealing for businesses and individuals to explore international opportunities. Prevention of tax evasion. The treaty would facilitate the exchange of information between tax authorities, thereby helping to combat tax evasion and fraud. Fair taxation. The treaty would ensure that tax burdens are distributed fairly and that taxpayers in similar circumstances are treated equally. Now, let's explore the key principles of international taxation. These principles help determine how and where income should be taxed, ensuring fairness and consistency in the global tax system. Understanding these principles would help appreciate the specific provisions of the tax treaty between Nigeria and ECOWAS countries and how it helps streamline tax obligations and promote economic cooperation. The principles include residence principle. According to the resident principle, individuals and businesses are taxed based on their residence status. Residents are taxed on their worldwide income, while non-residents are taxed only on the income sourced within the country. Case study: Global Consultant. Sarah, a Nigerian resident, provides consulting services to clients in multiple ECOWAS countries. Under the residence principle, Sarah is taxed on her worldwide income in Nigeria, which means she needs to report and pay taxes on her earnings from all countries, including those from her ECOWAS clients. However, due to the tax treaty, Sarah can claim tax credits in Nigeria for any taxes paid in other ECOWAS countries, therefore avoiding double taxation. Source principle. The source principle dictates that income should be taxed in the country where it is generated. This principle ensures that the country providing the economic environment for income generation receives tax revenues. Case study: export business. XYZ Limited, a Nigerian company, exports goods to Ghana and earns profit from these sales. According to the source principle, XYZ Limited is to pay tax on the profits earned from sales in Ghana to the Ghanaian tax authorities. XYZ Limited will not be taxed again in Nigeria on the same profits if a tax credit is available for taxes paid in Ghana. Avoidance of double taxation. Double taxation occurs when the same income is taxed in two different countries. Treaties like the one signed by Nigeria and ECOWAS countries aim to prevent this by providing mechanisms such as tax credits and exemptions. Case study: multinational employee. John, a Nigerian resident, is employed by a company in Ivory Coast and spent significant time working there. Without the treaty, John might be taxed on his salary in both Nigeria and Ivory Coast. However, with the treaty, John can apply for tax credit in Nigeria for the taxes paid in Ivory Coast, ensuring he is not taxed twice on the same income. Now, let's explore the key provisions of the treaty. Elimination of double taxation. Income earned in one ECOWAS country is not taxed again in another member country. This covers income such as employment income, business profits, dividends, interest and royalties, capital gain from the sales of assets, inheritance. Determining tax residency. The treaty sets clear criteria for determining tax residency to avoid conflict over which country has the right to tax certain incomes. Typically, an individual is considered a tax resident if they spend more than 183 days in a country within a tax year, have significant ties such as a permanent home or primary economic interest. Mechanism for tax credits and exemptions. Tax credits. Residents of one ECOWAS country can claim a credit for taxes paid in another member country, which is applied against their tax liability in their country of residence. Exemptions. Certain incomes may be exempt from tax in one country if they are already taxed in the other country, preventing double taxation. Exchange of tax information. The treaty includes provisions for the exchange of tax-related information between member countries to enhance transparency, combat tax evasion, and ensure proper tax administration. Non-discrimination clause. The treaty ensures that nationals of one member country are not subjected to more burdensome taxes than nationals of another member country in similar circumstances, promoting fair treatment across the region. Based on this provision, the treaty provides various benefits for both businesses and individuals. For businesses, this includes reduced tax burden and encouragement for investment. For individuals, it includes simplified tax compliance and financial stability. Now, let's explore more case studies. Case study 1. Cross-border business expansion. ABC Limited, a Nigerian manufacturing company, plans to expand its operation to Ghana, but fears double taxation on profits earned. Application of the treaty. Under the source principle, ABC Limited will pay corporate income tax on profits earned in Ghana as per Ghanaian tax laws. However, under the residence principle, the profits repatriated to Nigeria will not be subjected to additional corporate income tax. Instead, Nigeria will provide a tax credit for taxes paid in Ghana. As a result, ABC Limited benefit from reduced tax liabilities, making the expansion financially viable. Case study 2. Individual cross-border employment. Mr. Ade, a Nigerian resident, works for a company that requires him to spend significant time in both Nigeria and Ivory Coast. He fears double taxation as he earns income in both countries. Application of the treaty. According to the residence principle, if Mr. Ade spends more than 183 days in Nigeria, he will be considered a Nigerian tax resident and his income will be taxed primarily in Nigeria. However, if Ivory Coast taxes the same income, Nigeria will provide a tax credit for the taxes paid in Ivory Coast. This ensures that Mr. Ade avoids double taxation and enjoys clearer tax obligations, providing greater financial stability and predictability. Case study: inheritance across borders. Mrs. Amina, a Nigerian citizen, inherits property from her uncle in Senegal, and she is concerned about inheritance tax obligation in both countries. Application of the treaty. According to the source principle, the property is subject to inheritance tax only in Senegal, where it is located. Nigeria will not impose additional inheritance tax on the same property. This means Mrs. Amina benefits from reduced tax complexity and liability, enabling her to fully inherit and utilize the property without additional financial burdens. The following are the recommended actions for stakeholders. Stay informed. Regularly review the provisions of the tax treaty and any updates from the Nigerian government and ECOWAS. Consult tax experts. Engage tax professionals to understand the specific implication of the treaty on your business or personal finances. Plan strategically. Develop tax planning strategies that leverage the benefit of the treaty to optimize your tax position. Comply with reporting requirements. Ensure accurate and timely reporting of income and taxes to both Nigerian and ECOWAS tax authorities to avoid penalties. In conclusion, Nigerian tax treaty with ECOWAS countries is a step toward deeper economic integration, which eliminates double taxation, thereby simplifying tax compliance and enhancing the attractiveness of cross-border trade and investment. By understanding and utilizing the provisions of the tax treaty, businesses and individuals can optimize their tax liabilities and enhance their financial and operational stability within the ECOWAS region. And there you have it. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.